I guess like one girl like will get like half of the whole class. I don't think it's fair. How we just do clear communication, and then he got pissed at it. I don't know. He's like, "What are you trying to turn the class again?" Yeah, he had her. And he had her stated. Yeah, it was really. Let's AirPods. I did, but I have to. He has to go on his outline feed. You know why I found a character? I remember why. He went on vacation. He had like a million characters. He had AirPods Pro and went on vacation. Olivia taking AirPods at the case. So he got him. And then he bought these. They was pissed at Olivia. They don't really sit well. They don't sit like the other ones. They don't sit right.
Okay, for a few last loose ends, we're getting to the closing parts of the class. We have, after this class, we have 3 more sessions left. Next week and the Monday after. On the Monday of the last class, which is May 9th, that's the day your project is due. It doesn't have to be due in class, but by the end of the day. It is a group project report, and you've seen the multiple formats from, I gave you the link for the past projects. Some people use PowerPoint, some people use Word. The one thing I would ask you to do is no matter what format you use, convert into a PDF file. So if you make a PowerPoint presentation, because it's easier for me to put comments into a PDF file than it is into a Word or a PowerPoint file. It's easier for you to read as well. So make it a PDF file. Make sure you list all of the people in your group on the front page, because the grades have to be recorded. And please put them in alphabetical order, even though you might believe that you did the most work and you think you might be, it just makes entering it's the logistics becomes a lot easier. So today we're going to continue complete our discussion of patterns. Let's review where we are. I won't use the start of the class test today because it's kind of obvious. So remind me again, if you have a non-viable patent, you would still pay for it. Why? Because good things can happen, right? Would you rather get a long-term non-viable patent or a short-term? You want more time, right? You want to get a non-viable patent in a risky business or a safe business? You want riskier businesses because that's how non-viable patents become viable. And the minute a non-viable patent becomes in the money, it's become viable, will you take it? Not necessarily, right? Because you trade off. Should I wait and get more information, make this a better product? So today I want to complete the section on using patents, because if you remember for Biogen, I valued Avanex as an option. The value that I got for the option was $907 million, well above the discounted cash flow valuation. I also valued Biogen's existing products, which had been licensed out. And there I did this little tweak where I took their cash flows and discounted them back at the cost of debt of the companies that I had essentially guaranteed the payments, because that's what the risk is. That gave me the second slice, but this is the third slice. Biogen continues to have an R&D department. That R&D department presumably is trying to get more patents. The question is, what does that R&D department add or detract from value? So let's step back. R&D is like any other investment, right? For it to add value, whatever you invest, you got to earn more than your cost of capital. So here, let's assume that I told you that Biogen's R&D expenses were $100 million last year, and they're going to grow 20% a year for the next 10 years. So that's what they're going to spend. I'm also going to add that this R&D is going to be value adding. In what sense? Every dollar invested in R&D is going to translate into about $1.25 in value. That's about a 3% excess return. If your cost of capital is 9%, you earn 12%. That's about a 25-cent value add. So if you invest $1 in R&D, you're going to get $1.25 in expected value. After year 10, I'm going to assume you're going to start earning your cost of capital. So you're going to create value for the next 10 years from your R&D. I'm going to try to estimate how much that value added. So each year, here's what I started with. So the third column is my starting column. That's my expected R&D expense because the company told me how much they were going to spend. You multiply 120 by 1.25, you get the value of the patents added. So that's 30 million in value that was created in year one. And I do that for every year. There's my excess value created over time. Of course, this is a very uncertain stream. It's not like the licensing stream, which is close to riskless. I discount the value added by 15%, reflecting the higher uncertainty. What I get as a present value is $318 million. You're saying, what does that tell me? That's the value of my R&D department continuing over time. In fact, let's do a what if. What if I'd created $1 in value for every dollar I spent? What's going to happen here? The value of the patent will be equal to the R&D. The value added is going to go to zero. The R&D department won't destroy value. It's just there. So the value of a continuing R&D department is entirely a function of what you think you can generate as returns on that R&D over time, and whether it's greater or less than your cost of capital. So now I can bring all three pieces together. The 397.13 million is the value of their existing licensed products, 50 million a year for the next 10 years. So basically, I just took the present value at the pre-tax cost of debt. The 907 million is the value of Avanex as an option. So that's from the option pricing model. The $318 million is the value of continuing R&D. You add the three numbers together, you come up with a value of 1.622 billion. You know what that number is? That is what in a traditional DCF model, how you discount cash flows, get to, that's the value of your operating assets. Just an alternate way of getting there, instead of projecting out the cash flows for the entire firm and putting in the drugs into the growth rate, I'm breaking it up into, it's like a sum of the parts valuation for a pharmaceutical company, right? Existing products, patents, continuing R&D. I'm valuing them as three separate pieces, bringing them together. So can you do this for a company? I mean, somebody here must be valuing Moderna, right? Is anybody valuing Moderna? I think somebody is, but they're not in the class right now. But if you're valuing Moderna, you see how this perspective can be useful. Moderna does, it's a very young company, pharmaceutical. It does have the vaccine out there, which is a commercial product. You can estimate the value, but it also has the patent on the mRNA technology, which could be used in a bunch of other places. You could argue that if you valued Moderna, you could take the present value of the cash flows from the vaccine, the value of mRNA as a technology, and the fact that they have a continuing R&D department might lead you to add an additional amount of value. I'm not saying it's going to be easy, but it'll give you a different perspective on where Moderna's value is coming from. Remember, I said there's a three-part test we need to go through with every real option. Let's try the test on patents. Is there a patent? Well, clearly there is an underlying asset. The product that comes out of the patent is the underlying asset. The contingency is if the present value of the cash flows from that product exceed the cost of development you will develop. That's the S minus K. And if it's less, you're going to sit and wait. Is there exclusivity? Where does the exclusivity come from when you have a patent? But the government will back you up, right? You see already what happens when you have governments that don't enforce patents. If you have governments that don't enforce patents, the optionality pretty much dissipates almost overnight. But we're really stretching the limits by using an option pricing model. I use the Black-Scholes model to value Avanex as an option. But think about it. For option pricing to work, you need replication and you need arbitrage. For replication, you need to be able to trade the underlying asset. You need to be able to trade the option. I can't trade patents. There's no market. I can't go look up the price of a patent. You can't trade the drug that comes out of the patent either. This is about as far as we can get from meeting the requirement. So my only, it's not that you cannot use an option pricing model to value a patent. You can't monetize it. What does that mean? Your bargaining position becomes weaker, right? So if you're sitting across the table from me, I'm Merck, you're trying to sell me Avanex for 907 million with your option pricing model. I'm not paying 907 million. And my response is, if you think it's worth 907 million, why don't you walk out of that door and see if you can get the 907 million? Because it cannot be monetized, you might have to accept less than the 907 million. So it's not that you cannot use an option pricing model, it's more difficult to monetize that. Use a second example of the option today. We look at an oil company, a gold mining company, a coal mining company. almost every commodity company, there are two streams to the company. The first is developed reserves, from which they're extracting oil, selling the oil, getting cash flows. But they have undeveloped reserves as well, which is reserves that if they wanted to, they could develop. They have the right to develop them, but they might not. What drives whether you develop those reserves or not, generally speaking, with the commodity company? But the price of the commodities, right? If oil prices are 80, you're more likely to develop the reserve than if it's 30. You could argue that those undeveloped reserves are like options. So let's put some meat on this argument again. Let's assume you have undeveloped reserves as an oil company. Let's keep it an oil company for the moment. You can extrapolate to any other natural resource company. You have undeveloped reserves. Let's say the cost of developing these reserves is X. For the moment, stay with abstractions. Let's say the value of the oil in the ground that we extract and sell in the market is V. If V is greater than X, you will develop the reserves and keep the difference. But if V is less than X, what are you going to do? You're going to sit, wait, hope, and pray. Then what happens? Oil prices go up. That's an option. In fact, if I were to draw the payoff diagram, the cost of developing the reserve becomes the equivalent of the strike price. The value of the oil under the ground becomes the equivalent of the underlying asset. And if the value of the oil exceeds the cost of developing, you'll develop the reserve, keep the difference. But if that never happens, what do you lose? How did you get these reserves in the first place? First is you bought the reserves. Governments often have auctions of reserves. The US government, in fact, suspended the auctions of reserves at the start of this year, but they might start up again because of oil prices being where they are. The second is exploration. Like R&D, you do exploration. You have to, so if oil prices never rise, you say, I wish I hadn't done that, but that becomes the cost of the option. So let's try this on a company. And I'm going to go back in time to the 1980s, and I'll tell you why I haven't updated this example to a more recent one. A company called Gulf Oil, early 1980s, gets targeted in an acquisition. The acquirer, I'm sorry, and I'm going to come up with the inputs for valuing the reserves at Gulf Oil. So let's lay out what the inputs have to be. To value these undeveloped reserves as options, let's list the 6 inputs you see in an option pricing model. The S in the model is the value of the oil under the ground. So you need to know how much oil there is under the ground in terms of barrels of oil. You have to project out what you produce every year, what the expected oil price is. It's like a capital budgeting project, the present value of the cash flows from developing the reserve today. So I'm not asking you to be clairvoyant. I'm saying, given where oil prices are today, what would the value of the oil be? That becomes the S in the model. The strike price here is the cost of developing that reserve. That oil companies have a pretty good idea, right? If I gave you a Gulf of Mexico reserve, this is the first time you've developed reserve in the Gulf of Mexico. And the cost can vary across the world. Now, Saudi Arabia, you stick your finger in the sand, oil comes out of the ground. Cost of developing the reserve is almost nothing. In Canada, especially in the northern reaches of Canada, you know how much work it is to get to the oil? It's 5,000 feet under the ground and it's frozen. Cost of developing the reserve is going to be huge. So the K might vary depending on different, but there is a K, there's a strike price, the cost to develop. The time to expiration here is tricky. When you bid at a government auction for reserves, you don't get those reserves in perpetuity. You get them for the next 20 years, the next 15 years. If you develop those reserves, you can, but at the end of 20 years, guess what happens? The reserves revert back to the government. That becomes the life of the option. In terms of variance and value, this is one of the easier real options to value. Because when an oil company has reserves, the biggest uncertainty they face is not about how much they have in reserves, but what price they will get. The oil price becomes what I look at when I think about variance in the option. For the net production revenue, remember, once a reserve becomes viable, you're going to face this choice. So let's say your cost of development is 30 and the oil price is 35. The reserve is not viable. Part of you wants to develop, right? But what's the other part saying? If you wait, the oil price could go to 60. It could go to 70. Every oil company through time has faced this question. So I'm going to up the ante. I'm going to say, once the reserve gets viable, you can wait if you want, hoping. But if you wait, you give up the cash flows you could have made from developing the reserve. That becomes like a dividend yield. What you give up by not developing the reserve. And finally, there's a practical issue you run into. especially with natural resource reserves. Let's say oil prices stay at $100 a barrel. You're in charge of ExxonMobil. You decide you're going to develop all your reserves today. So you pick up the phone or whatever electronic communication device you have, and you tell employees around the world, develop all our reserves right away. Is oil going to come out of the ground tomorrow? It's going to take a while, right? They've got to go put rigs in the ocean. It might take a year, and in fact, I wouldn't be surprised if it took 3 years. You see what I'm saying? It reduces the value of the option. And here's why. You're developing these reserves because oil prices are $100 a barrel, but the oil is not going to come out of the ground until 2 years from now. So what are you worried about? You develop the reserve, but 2 years from now, oil prices will be back down to 35. Now you could try to lock in the prices using futures contracts, but it means that you have to wait to get to your cash flows. So let's look at how this plays out. And I'm going to use Gulf Oil as my example. Early 80s, it's targeted in an acquisition. It's targeted primarily because it has lots of undeveloped reserves. In fact, its reserves were 3.038 billion barrels of reserves in different parts of the world. The cost, if you decide to develop all these reserves, is about $10 a barrel. So 30.38 billion, they spend it today, will mean they can develop all the reserves today. They have 12 years of life left on these reserves. Right? Different parts of the world, they have rights for different periods, 3 years, 5 years. The weighted average is 12 years. The oil price, when I did this, was $22.38. So different age, right? 40 years ago, oil price for $22.38. And the variable cost of actually extracting the oil from these reserves is $7 a barrel. So they're making $15.38 a barrel. So file that away. If they develop the reserves today, they'll make $15.38 a barrel. The risk-free rate then was 9%. That was actually the US T-bond rate in 1982. Now, different time, different era, but it reflects what the higher inflation and the higher interest rates of that period. And finally, if Gulf Oil decides to develop these reserves, the cash flows they will get each year from developing the reserves will be about 5% of the barrel. Why? Because you have to stagger production. You can't produce all the oil right away. It's going to be 5%. So let's see how this plays out. Oh, and one more thing, the variance in oil prices is 0.03. So there is some uncertainty about what oil prices will be. So I'm going to try to value just the undeveloped reserves as an option. So first I said, if I develop these reserves today, what would I get as value? So I took the 3,038 million barrels. I multiplied by 1538, which is what you're making per barrel. And because I have to wait 2 years, so this looks like I'm discounting, but I'm just reflecting the fact that it takes 2 years for me to actually develop the reserves, to wait 2 years, what I get is 42.38 billion. If I develop these reserves today, the value of the oil I will get is 42.38 billion. The cost of developing these reserves is 30.38 billion. So if I just stopped and took the difference, I get 12 billion, right? 42.38. That is my discounted cash flow valuation for these undeveloped reserves. I want you to remember that number because now I'm going to bring in the optionality. Remember, they haven't developed the reserves. They have 12 years left. The variance in oil prices is 0.03. And the cash flows I will get once I develop the reserves is 5%. I plug the numbers in. The value that I get for these reserves as an option is $13.3 billion. My DCF value is 12 billion. My option value is 13.3 billion. Where's the extra 1.3 billion in value coming from? What is it that I see the company being able to do that adds to my discounted cash flow value? First, they don't have to produce the oil right now, right? $22.38 is a low oil price. What I'm bringing in is the fact that they can wait for a better price. Of course, that could be a bad mistake. They give up some cash flows in the process, but that is the optionality. Remember that variance of oil price was 0.03. If I made that 0, if I was certain about the oil prices, the value of the option will disappear. It's the uncertainty about oil prices that's creating the optionality. In fact, if I were to complete this oil company valuation, I'm going to do it in parts again. There is the value of the existing developed reserves, and they're throwing off cash flows. of $915 million every year for the next 10 years. If they did nothing but extract oil from their developed reserves, they're going to get $915 million cash flows, discounted back at an oil company cost of capital of 12.5%. I get a present value of $5.065 billion. That's a part of the company that's developed. The value of the undeveloped reserves is $13.3 billion. You add those two numbers up, again, it's like a sum of the parts valuation. What I get is a combined value is essentially what I get in a traditional discounted cash flow model as the value of the operating assets. Again, a different perspective on natural resource companies reflecting the fact that their undeveloped reserves have optionality. Now, the bigger point I would make is if you look at an oil company, the value of an oil company is determined by not just the level of oil prices, but also the variance in oil prices. The level of oil prices affects developed and undeveloped reserves. But if you have a lot of uncertainty about oil prices, it makes your undeveloped reserves more valuable. A company like Petrobras that gets 70% of its value from undeveloped reserves is affected almost as much by the variance in oil prices as it is by the level of oil prices. So that's the first stop, option to delay. You see it play out in patents, you see it play out in oil companies or natural resource companies. Let's move on to the second option. This is the one that really excites people who use the real options argument, because it allows you to override a very, very important lesson you learn in corporate finance, which is never take a negative net present value project, right? We're told over and over, don't take a negative net present value project. Here's the exception. What if you took a negative net present value project? You know it's negative net present value, but this project gives you a chance to take a second project down the next year, 2 years from now. That second project right now doesn't look good. So basically, you're taking a bad project that gives you a right to an even worse project. You think, that's terrible. Why would I want that? The second project, though, you can wait. And if things improve, that second project could essentially be a very lucrative project. That's why I use the example of a company entering China or India, big market. The initial investment you make is a negative net present value investment. But if things work out, think of the big market out there. So it's not the first project that's the option, it's that second project, it's the option to expand. So again, let me set this up in terms of a payoff diagram. So right now you're taking the bad project with the chance to expand anytime over the next 5 years. The cost that you will spend to expand becomes the strike price on the option. You will expand if the present value of the cash flows from expanding exceed that cost. It's an in-the-money option. Of course, like any out-of-the-money option, that might never happen, in which case, what did you pay to get this option? What did I make you go through right now to get this option? You had to take that bad project with a negative net present value. That becomes the cost of your option. So you could go into China taking a negative net present value investment and walk away 5 years later with nothing to show for it, but that's the nature of optionality. So I'm going to use, again, a kind of simplistic example, but maybe extrapolate from this, because I think this example is useful, especially in the market, kind of market we're in. Let's say you have a software company. It's a security software company. Basically, it provides software to protect companies from hackers and other people trying to get into their system. You project out the cash flows, you come up with the cost of capital, you come up with a value for this company of $115 million. This is your DCF. Now, if this is, up till now, we said, that's it, $115 million, that's what you should pay for the company. Let me add a qualifier. This company, as it's selling the security software, is also collecting a database of every hacker trying to attack the company. It's a database that can then be used to kind of fight off hackers. And it can create this database software based on this database because it now knows the hackers. It does the analysis right now, whether that database software is going to be of any value. They don't have much information. Based on what they know now, they estimate it'll cost them about $500 million to develop this database software anytime over the next 5 years. And based on what they know now, they think the expected cash flows from selling that software will be $40 million a year for 10 years. This is not going to be a good project, right? If you look at the numbers now, $500 million upfront, $40 million every year for the next 10 years. Even without discounting, I don't get to $500 million. And if I put a 12% cost of capital, the present value of the cash flows I get from this project based on what I know today is 226 million. So I'm giving you the right to do something that looks terrible right now. The present value is 226 million. The cost is 500 million. That's like a negative net present value of minus 274 million, right? But you have 5 years to make this decision. You're collecting information from your regular software. Things can change. In fact, how much can they change? You're in a very unstable market. Things are changing. The standard deviation in that 226 million is huge. It's 50%, which means it could go to 0, it could go to 600 million. If I throw in that 50% and I estimate the value of the option, it's almost magic. The right to take this project with a net present value of minus 274 million, that option is worth 56 million. What does that mean? If I'm buying this company and I incorporate that option value, I wouldn't pay 115 million, I'd pay 171 million, a premium over your discounted cash flow model. When 4 years ago, when Facebook had its Cambridge Analytica scandal, stock was trading at like 130. Stock was, stock was trading at 200, and after the scandal, it dropped around 130. I valued the company then at roughly 130. And I bought the company, and people were surprised. It's a fairly valued company. Why do you buy it? And I said, I valued Facebook as an advertising company because that's where the revenues are. Right now, they haven't figured out what else they can do with this 2.5 billion, at that time, 2.5 billion users on their platform. But those users are on their platform an hour every day. What if Facebook figures out something that they can do with these 2.5 billion? That's an option. Right now, there's nothing they can do, but there is this option to be able to take advantage of those users. They could sell them. They could do retail with entertainment. Who knows what they can do? I wasn't willing to put a number, but I said the 130 I get from a DCF model is my base. It's like the 115 million. There's a value of an option. I don't know what the numbers would look like. It'd be messy, but it's definitely a big number. And that, I think, is why people get so excited about platforms. One of the things about Twitter is that it's lots of users on its platform. The other aspect of Twitter is it hasn't been able to figure out how to make money of those users. I don't know why Elon Musk is buying Twitter, to be quite honest. We don't know why Elon does any of the stuff he does. But let's say he's buying it for business reasons. Last week, if you remember, I sent you that valuation of Twitter on April 4th, when he came into the game, and I didn't know he was trying to acquire the company. I valued Twitter with the status quo, the existing management place, and I came up with $45 per share. Elon Musk is paying $54.20, at least according to the numbers that I see. That looks like he's overpaying, right? But if $45 per share is the value that I'm getting with Twitter's advertising model, which is what I basically built here. What if Twitter can figure a better way of using this platform? You're saying, what is it? I don't know. I mean, they don't know. Musk doesn't know. I mean, they talk about subscription models, but let's face it, nobody, if it were that obvious that a subscription model could work, they'd have introduced it. Clearly, there's a lot of mess here that you got to get through, but that's an option. Is that option worth at least $9.20? I believe so. 330 million people on there. You know, if you figure out something you could do that's more lucrative than just selling advertising. This before I came to class, I got an email from Microsoft Share or Microsoft Start. It's this new venture in Microsoft where they invite you to share your documents. If I wanted to put PowerPoint slides or Excel slides, and they give you a chance to earn ad revenues from the shared space. And one of their big selling points is we have a platform of 1.3 billion people. That's all the people in Office 365, LinkedIn, all of the different platforms. So they're selling you on the aspect of we have a platform. We're trying to figure out how to make money on this platform. I don't know whether this will work, but what's the harm in trying? That's the options argument playing out in the real world. Now, as I said, this is a very dangerous room we've entered, right? Because in a sense, we're overriding intrinsic value. We're overriding traditional capital budgeting. We're taking projects that are bad projects on paper. And when people use arguments like strategic investment, they're using an options argument. They're not using that word, but that's what they're saying, right? The numbers don't fly, but let's do it anyway. So I want you to be ready to push back when people make this argument, because you want to be skeptical. You want to just buy in and say, it's a platform, let me pay for it. So first question you need to ask is, remember where I bound together two investments? I made you take that negative net present value investment to get to the option to expand. So first question you need to ask is, do I need to make the first investment to get to the second? So if you tell me, look, open these hotels in China because it'll give you a chance to expand to China, I'm going to ask you, do I have to open the hotels in China and lose money to get that? Or is there a different way of getting that? Maybe there isn't. Maybe I have to do one to get to the second. The second question I'm going to ask is going to be just as critical. Assuming I make the first investment to get to the second, what is the exclusivity that I have on the second investment? That's where Marriott fell, right? When they said, we're opening 10 hotels in China, and if it works, then we're going to open 500 more. My question is, what's so special about you? Why can't Hilton do it? And I want to hear an answer like the Chinese government has given me exclusivity in this part of China. So I'm looking for exclusivity. The stronger the exclusivity, the stronger the competitive advantage, the greater the value of the option. 90 times out of 100, people make real options arguments, and the option to expand argument, and you take them through this two-step test, you very quickly discover that 90 of those 100 arguments drop off. They're not going to stand up to scrutiny. So remember those arguments. Do I need to make the first investment to get to the second? And where's the exclusivity coming from? So let's take options to expand and take them to the three-part test. Is there an option? Yeah, technically, yes. The underlying asset is this option you have, the expansion project. And the contingency is the present value of the cash flows from expansion exceed the cost of expansion. You're going to do it. If not, it's like S over versus K. If not, you're going to wait and hope that something good happens. Second, is there exclusivity? Depends, right? If I got an exclusive license to expand, there is clear exclusivity. If it's, I have a strong brand name, therefore I have an advantage, it's weaker. What do you think about exclusivity coming from the fact that you have users on your platform? Every platform, when they try to sell themselves, look how many people there are on the platform. I'm going to give you a chance to ask me questions about my users that will tell you whether a platform has high option value or low option value. So in addition to the numbers, what else would you like to know about my users? Would you rather have users that spend an hour on your platform or 3 minutes on your platform? First is you're going to talk about intensity. In fact, in the last few years, increasingly user-based companies have been forced to report what are called daily active users. You know what those are? These are people who are actually on Twitter every day. Out of the 330 million people who are supposedly on the Twitter platform, about 100 million never show up. They're on the platform. Technically, you never leave, but that costs you nothing to have a Twitter account, right? But if you never tweet or you never read what other people tweet, well, it's almost like you're not there. So you're going to ask about intensity. You're also going to ask about retention. How many of these users have been around 7 years, 6 years? You see why that matters, right? You buy a platform with lots of users. Your nightmare scenario is they all leave after 6 months or a year. Platforms which have more users, more intense users who stay on the platform for multiple years are worth more than platforms without. I call this stickiness. Basically, how sticky are your users, where they want to stay on your platform because those are my valuable users. So if any of you end up becoming entrepreneurs, and many entrepreneurs now sell, that's their business, platforms, ask those questions because those are going to determine the value of the option. And finally, on the option pricing, again, very tough to get replication arbitrage going. So when you use a Black-Scholes model to actually value a platform, be very careful about how you use that number. You can't monetize it. It might give you a rough sense of high and low value, but the actual number is going to be malleable. Which brings me to my third option, which is the option to abandon. Most of the options we talk about in the context of real options tend to be call options. Patents, undeveloped reserves, the option to expand. The option to abandon is a put option. It gives you the right to walk away from a mistake. So let me frame it. You've invested in a project. There's a liquidation. So if you abandon the project, there's a certain amount of money you will get. Maybe sell off the land on which the factories are. If the present value of the cash flows from continuing the project are less than that abandonment value, guess what you're going to do? You're going to shut the project down, liquidate or abandon it, and take whatever you can. It will be far less than what you invested, but it's better than continuing the project and continuing to throw good money after that. So I'll make this real with an example. You've all heard of Airbus, right? The big competitor to Boeing. You also heard of Lear aircraft. It makes these little corporate jets. So I'm going to play the role of Lear, and you're going to be Airbus. And I'm going to come to you because I want to be in a joint venture with you. Why? Because I want to enter the commercial aircraft business, and I don't know enough about the business. But I can bring in this expertise of building smaller aircraft. So I come to you with a joint venture proposal. I'm going to put in $500 million, and you're going to put in $500 million. So it's going to be 50-50. And we're going to produce these commercial aircraft. So you as Airbus decide to check out the numbers. So you're investing $500 million. You project the cash flows you'd make from this joint venture. And let's say the present value of the cash flows is $480 million. Let me pause right there. You're investing $500 million, you get back $480 million. That's a negative net present value project, right? So you come back and say, not interested, but I really, really want you as a joint venture partner. So I offer you a deal. I said, look, if you become my joint venture partner, it's a 30-year project, you can walk away from this project anytime over the next 5 years, and I will pay you $400 million. You're saying that's less than the $500 million I invested. It's true. But what have I done? I've floored your losses, right? You can't lose more than $100 million. I've given you the option to abandon this project and take $400 million. I've given you a put option. And in fact, there's a lot of uncertainty about this business. Let's say it's 0.16 is the variance in value. You can see why you might be induced to becoming part of the project. So let's value that put option. Here's what the inputs look like. The S in the model is the present value of the cash flows as of right now, $480 million. The K in this model is what you will get if you walk away, 400. Would you walk away today? No, because you get more than the 400. But you have 5 years. If something terrible happens here and it doesn't look like any corporate jets will be sold, you can come to me in the third year, the fourth year, or even the end of the fifth year and receive 400 million and you're done. There's a lot of uncertainty. So who knows what will happen over the 5 years? The life of the option is the 5 years that you get the chance to exercise this. But the project is a finite life project, right? So every year that you look at the project, there are fewer years of cash flows left. So almost by description, this project is going to get less valuable over time if nothing else changes. 29 years and 28 years and 27 years of cash flows. So there's almost like a dividend yield. Each year the project is losing value. I have pretty much everything I need. The risk-free rate is 6%. I valued the put option. And the value that I got for the put option was 73.23 million. You're saying, what does that tell me? As Airbus, because you got this option to abandon, you essentially got a 73.23 million gift from me. Remember the net present value was minus 20 million before I gave you this gift? Now with this option to abandon, I'm not saying you're guaranteed to become my joint venture partner, but you might be tempted. The only thing I have to be careful about as Lear is I gave you this put option worth 73.23 million. So what should I be sure that I am getting? That my net present value is well above 73, because I can't go around gifting these big put options if I don't have a net present value high enough to cover it. The option abandoned is actually a very, even if you never value it, has some very interesting implications. The first is, it tells you the value of being flexible. This is a word you often see, especially in the aftermath of COVID, that companies need to be adaptable and flexible. When I hear that, I'm talking about, one of the things I hear about is the option to abandon, to be able to walk away from your mistakes. In fact, there are implications even at the project level. If you buy into this option to abandon, you want to make sure you have more costs, more of your costs are tied to your revenues. That's why an Airbnb has an advantage over a Marriott or a Hilton, is you want to create a more flexible cost structure. If you're given a choice when entering into long-term contracts or short-term contracts, it actually should push you to a shorter-term contract because you don't lock in things for the next 30 years if you're uncertain about the future. Now, a lot of companies are often reluctant to build in escape hatches, especially these big infrastructure companies. Why? Because they're viewed as a sign of weakness. They say, look, we're so convinced that this is a good project, we're going to show you by not having, which strikes me as insane. You have a 30 or a 40-year project, you need to be able to walk away. And if that costs you money, put it in. It's good to have that capacity if things don't work out. Option to expand, option to delay, option to abandon. Take a little bit of a tangent here and talk about how options play out in companies' capital structure decisions. The most obvious place where options show up in the capital structure decision is in the design of securities. When we talked about convertible bonds, a convertible bond is a call option on part of a straight bond. When you have floating rate debt, often floating rate debt comes with caps and floors. Caps and floors are really options. So one place that options show up in fixed income is in the design of securities. I have zero interest in going there because that's why you have a fixed income class. I'm going to talk about another place where you're going to see this options argument come about. Now, you in your corporate finance, I don't even know whether it's called corporate finance. Is it called corporate finance now? Because when I taught it, they asked me to call it financial management. I said, no, I'm going to call it corporate finance. Maybe they've renamed it since. But in your corporate finance class, did you talk about optimal debt ratios and how to find the optimal debt ratio? You did? Well, you should have. Well, I'll fill in the gap. So when you think about companies and you think about an optimal debt ratio, an optimal debt ratio is one where your cost of capital is going to be lower than your existing debt ratio. So you're at 10% debt and your cost of capital is 12%. If I can show you that at 30% debt will be 11%, that's a better debt ratio because a lower cost of capital gives you a higher value. So in my corporate finance class, every person has to pick a company and they come up with an optimal debt ratio for the company. And then they compare the actual debt ratio to the optimal. And I'll tell you what the mix is. It's going to be 70% under-levered, too little debt, 20% over-levered, too much debt, and 10% around the correct debt ratio. But if you look at an under-levered company in a corporate finance class in a static world, you know what we tell them, right? Move to your optimal, you'll have a lower cost of capital. But I'm going to give you an argument for why companies might not want to move to their optimal. You're at a 10% debt ratio. The optimal is 30%. You might say, look, I want to hold on to my excess debt capacity. To do what? Two things. One is something bad happens, it'll give me a buffer. Two is if the greatest project of all time lands in my lap 6 months from now, here's what I plan to do. I plan to use my excess debt capacity to take that project. It's an options argument. Using the excess debt capacity is going to allow you to take this great project in case it comes along. Of course, it might never come along, in which case, what did you lose? By being under-levered, you had a higher cost of capital, but you said, I'm okay with it. That's the cost of the option. It's a very messy option to draw, so I'm going to try. You take any company, there's a certain amount of your reinvestment needs you can meet through your regular financing, your bank credit lines, So let's suppose that's your strike price. So if it's 6% of value, it's up to 6%, you have no problem. You can raise the capital and take the projects. But let's say the greatest project of all time comes along and it requires more than 6%. Here's where your excess debt capacity helps. Because you have excess debt capacity, what can you do? You can go borrow money because you have the excess debt capacity and take this great project that's now 15 or 20% of value. Now, what do you gain by taking the project? The net present value of that project. So in a world where you think about excess debt capacity as an option to take projects, this is what people mean when they talk about financial flexibility. Financial flexibility allows you to do things that you otherwise couldn't have done because you held back in the first place. It's a very difficult option to value, but I'm going to try. Now, but one of the companies I use in my corporate finance class as an example, it's been running through my class for the last 25 years, is Disney. Okay. So 1997, first edition of my book. So you want the most recent version, you can take the most recent edition. First edition of book, I compute an optimal debt ratio for Disney. And the way you compute optimal is actually very simple. There's no, as I said, I can catch you up if you never did this in your corporate finance class. What you do is you take at every debt ratio, you compute the cost of equity, which comes from using the levered beta. So as the levered beta changes, the cost of equity changes. And at every debt ratio, you compute a cost of debt based on a synthetic rating and an interest coverage ratio. And then you look to see where your cost of capital is minimized. So if you look at Disney in 1997, the cost of capital is minimized at about 40%. At that debt ratio, their cost of capital is 11.64%, whereas at their existing debt ratio, it's 12.22%. So let's stop right there. By not moving to their optimal, by staying at 18%, what do they give up? A cost of capital that's about 58 basis points, 0.58% higher than it should be. So you tell Disney you should borrow more. You have a debt, optimal debt ratio of 40%. But Disney's management pushes back, says, no, we don't want to do that because we value financial flexibility. We want to be underlevered. We want to have the excess debt capacity. Let's take them at their word and see how much financial flexibility is worth. So here's what I did. I went back and looked at how much reinvestment was at Disney each year. Reinvestment, of course, is net capex and change in working capital. I went back over time. And the reinvestment as a percentage of value over the last 5 years was about 5.3% on average. But there was a lot of ups and downs in it. The variance in that number was 0.375. So basically 5.3% is what they require in a typical year, but there's a lot of uncertainty. It could be 8, it could be 3. And in a normal year, Disney can raise about 4.8% of its value from traditional credit clients and banks. I'm going to try to value the financial flexibility on a 1-year basis so I can compare it directly to the 58 basis points I'm losing by not being at the optimum. So here's what my numbers look like. I first put in those numbers into an option pricing model. But then once I got the value of the option to take a project, I had to bring in a second factor, which is the value of a project comes from its net present value. If Disney is going to take projects with a 0 net present value, I don't want them to have financial flexibility. In 1997, Disney was earning a return on capital of 18.69% on its projects, and its cost of capital was 12.22%. It was earning 6.47% more than its cost of capital. You bring that in and you assume that the new projects that Disney will look at have the same excess returns. The value that I get for the option is 0.85% of that. So let me give you the trade-off. If Disney moves to its optimal, its cost of capital will be 0.58% lower. But if it moves to its optimal, it loses its financial flexibility, which is worth 0.85%. What does that tell me? Disney should stay under level because the value of financial flexibility then exceeds what they will gain by moving to the optimal. As I said, actually putting a number in financial flexibility requires all these assumptions. But there are insights you can get from the setup that I think are much more useful. Here's my foot. So if you look at the value of financial flexibility, I'm going to give you 3 determinants of financial flexibility. When I told you I need excess debt capacity to take projects, I was implicitly telling you a couple of things. One is I don't have much in terms of internal cash flows to cover those projects. And I was also telling you something about my access to capital markets. You know, in traditional corporate finance, no company needs excess debt capacity. Why not? Because if you have a great project, I assume just go raise the money, take the project. What's the big deal? So I'm going to use that to draw 2 implications. The first is, if you're a company with significant internal cash flows coming, you have a lot of retained earnings, you should value financial flexibility less than a money-losing company or a company with low cash flows. Everybody agree with that? Here's the second one. Companies with much better access to capital markets should value financial flexibility less than companies without that access. So if I'm looking at 2 companies, both of which are underlevered, a $1 trillion market cap company and a $10 billion small company, I'd be much more willing to listen to the small company make the argument about financial flexibility than the trillion. I mean, Google shouldn't be making an argument about financial flexibility because they can raise as much capital as they want. Emerging market companies should be more underlevered than developed market companies. Do you see why? Because if you worry about capital constraints and being able to raise capital, you should be more underlevered if you're an Argentine company than a US company. So that's the first driver. Second, remember the 5.3% that I estimated as reinvestment in Disney? Let's say that you have 2 companies. They both have 5.3% of their values reinvestment needs. The first company, though, it's 5.3% every year. It's very predictable. The second company goes 5.3, 9, 1. What drives it? The kind of business you're in. Some business aren't predictable. The company with unpredictable reinvestment needs should value financial flexibility more than one with predictable reinvestment needs. For common sense reason. If it's predictable, you can plan for it. You can borrow money in advance. But if it's unpredictable, it comes out of the blue, it's good to have that excess debt capacity. Which leaves me with the third and final determinant. This is not an option to take a project. It's an option to take a good project. I know whether you remember that graph I showed you about returns on capital at companies globally versus the cost of capital. Out of the 45,000 publicly traded companies, I said 60% earned less than the cost of capital. If you're one of those companies, don't even talk financial flexibility with me, because if you say, I want excess debt capacity to take projects, I'm going to shut you down right there. Why would I want to give you the option to take projects if your projects are bad projects? The more lucrative the returns you have in a business, the greater the value of financial flexibility in that business. You take those characteristics, you can see why tech companies tend to be underleveraged. Can Google afford to borrow more money? Absolutely. But they don't. Why? They're in a business where things are more unpredictable, the optionality kicks in more. It gives you a way of understanding why some companies might choose not to borrow money, even though they have the capacity to borrow money. Which brings us to the final way in which we're going to use option pricing. When you buy equity in a publicly traded company, there are two things that come with your holding that essentially make equity look like an option. The first is equity is a residual claim. You know what that means? Every year you get whatever's left after everybody else has been paid. And if you liquidate the company, you get whatever is left over after you've paid off. You're the last person. It's a residual claim. The second aspect of equity that makes that you have to think about is in a publicly traded company, equity has limited liability. You know what that means, right? The most you can lose is what you paid for the shares, but you can't go below zero. Thank God for that. Can you imagine your broker calling and say, your stock is now trading at minus $15 per share. Please send in 15. The reason that doesn't happen is you have limited liability. Residual claim plus limited liability. Let's see how this plays out in a payoff diagram. You guys be the equity investor in the company. I'll be the lender. I gave you the fun job. You get to run the company. And could you liquidate the company if you wanted to as the equity investors? Yeah, it's a decision. You can say, look, we're liquidating. If you liquidate the company, you're going to get whatever you get from selling off the assets, right? I'm the lender. So if you liquidate the company, you sell off the assets, you pay my debt off first. And if there's anything left over, you keep it. But what if you liquidate the company and what you get from liquidation is less than the face value of the debt? You just walk away saying, sorry, limited liability. I can't come out. I can't come after your house, your personal portfolio. See, that looks like a call option to me. The underlying asset is the business. The strike price is the debt you owe. And the most you can lose is what you paid for the shares. I'm going to use that to bring out, I'm going to start with a very simplistic example to show you how powerful this can be in explaining a lot of stuff that goes on out there. So I'm going to come to you with a company. You continue to be the equity investor. I'll be the lender to the company. You're the equity investors. The value of this whole company is 100 million right now. But there's a lot of uncertainty. The standard deviation of that value is 40%, which means it could go up to 200 million, it could drop to 20 million. I've lent you money, and I've lent you money with one 10-year zero coupon bond. Very rigid, but you're going to see in a minute why it's structured this way. The face value of that bond is 80 million. So if you liquidated the company today, I'll collect my 80 million, you get whatever's the difference, but you have 10 years on the bond. In addition, the T-bond rate is 10%. I'm going to argue with that minimalist information. I haven't told you anything about cash flows or betas or cost of capital. You should be able to tell me how much equity in this company is worth and what interest rate I should be charging you as a lender. There's no bond rating. So let's see how we'd structure this. You're the equity investors, you own a call option. The underlying asset is the company. The value of the asset becomes the S in the model, 100 million. The K here is what you'd have to pay if you liquidate, the face value of the outstanding debt. But for the next 9 years and 364 days, I cannot do a thing to you. Why? Because you don't owe me money. Now, do you see why I constructed this as a nice zero coupon bond? I've given you free rein for the next 10 years. On a traditional bond, though, what will happen every 6 months? That gives me some degree of power. You'd have to make interest payments to me. And if you don't make it, I'll take over the company. So here I've essentially relieved you of that responsibility. For the next 10 years, you get to run the company. The variance is the 0.4 squared, which is 0.16, and the riskless rate is 10%. I'm going to plug the numbers in SK, RT, and I come up with D. Remind me again what N of D2 is? It's the risk neutral probability that this option will be in the money, right? But think about what that means. S is the value of the asset, K is the outstanding debt. There's a 63% chance that the value of my assets will exceed my debt, which means there's a 37% chance of bankruptcy. The value that I get for the equity is 75.94 million. That's what your equity is worth. But remember, the entire company was worth 100 million. So if your equity is worth 75.94 million, my debt has to be worth 24 million. And since it's a nice zero coupon bond, 80 million due in 10 years, 24 million today, I can back out the interest rate on the debt at 12.77%. That's a default spread of 2.77%. Valuing equity as an option is a way of breaking up the value of the business into what belongs to equity investors and what belongs to lenders. I'm going to take this example. And as I said, I'm going to try to extract some general lessons. So let's say you look at this analysis and you decide to pay 75.94 million for the equity. And I settle for 24.06 million for the debt. Tomorrow you wake up to some catastrophic news. Half your company has disappeared. Don't ask me how. You have two factories, one in Florida, one in California. Take your pick, hurricane or earthquake, but pick just one. Half the company has disappeared, no insurance. The value of the firm has gone from 100 to 50 million. Bad news, obviously, right? But I have a very simple, pragmatic question. The value of the equity before this happened was 75.94 million. You've now lost 50 million of the firm value. What will happen to the value of your equity after this catastrophe? And I'll give you the choices. It'll drop by exactly 50 million. It'll drop by less than 50 million. Or maybe you listen to your accountants and they say book values turn negative, it drops to zero. So what do you think the right answer is? That the value of the equity dropped by 50 million, less than 50 million, more than 50 million? If it drops by less than 50 million, you have a problem, right? You have to explain who else is. So who's the other player? Who are you going to drag into this game, even though they don't want to be in it? You lost value, obviously, because the firm is worth less. I was a lender, right? Am I affected by this? I lent to your company yesterday when it was a $100 million company. It's now a $50 million company. I'm going to wake up and say, this is a much riskier company than I thought it was, right? So here's what happens. If I take the option, change just the S in the model, because everything else stays the same, from 100 to 50 million. Same K, same R, same T. Here's what I get as my D1, D2. Let me do my first equity value. Equity value is now 30.44 million, $45.5 million less than it used to be, but only 45.5 million, not 50 million. But my debt drops by 4.5 million. My debt has become riskier. Why has it become riskier? Take a look at ND2, 41.6%. How do we use that? There's a 41.6% chance this company will make it, but now the probability of failure, or bankruptcy, which was 37%, is now up to 58.2%. Basically, the company has become riskier, default risk has gone up, equity value has gone down. And that was by lowering the value from 100 to 50 million. Once I got started on this, I couldn't stop myself. And here's what I did. I knocked the value down to 40 and then 30. Same debt, same company, but I kept knocking the value down. You know what I was trying to answer, right? When does equity become worthless? And I couldn't make it go away. It's an incredibly stubborn instrument. I knocked the value of the business down to 5 million. I still owed 80 million, and the value of the equity hung in there. So I have a question. What's keeping the value of equity afloat here? It's obviously a basket case company, 5 million value, 80 million in debt. What's keeping the value of equity afloat? Variance is part of it, the uncertainty, but it's variance plus I need something else. Time, right? I have 10 years. Remember, the debt doesn't come due till 10 years from now. I'm sitting there, I'm hoping that something good will happen. I'm praying that something good will happen. Then maybe the variance will make the value go up. Most of the time, when you hope that something good will happen and pray that something good will happen, nothing good happens. And you lose it all. But maybe that once in a while that you're buying this equity for the same reasons you buy deep out of the money options. Think about that reality the next time you see stock in a basket case company continue to trade. You have a company that's got immense amounts of debt, is losing money like there's no going out. I mean, there's no chance of it turning around, at least in the near future. People still buy stock in that company. They're buying it for the same reasons they buy deep out of the money options. I'll tell you, when I did this graph, it gave me an entirely new perspective on what bankruptcy meant. And actually, I should have learned this because my daughter, who turned 27 yesterday, taught this to me when she was 3 years old. Incredibly precocious individual. So that actually a summer when I used to play Monopoly with my 2 older sons. And my daughter would want to join in. And she was persistent. So finally, I said, Kendra, you can join in. And after 2 rounds, I had to banish her from the game. Because she was like a one-person android. You know how in Monopoly, you collect $200 every time you pass go? She just collected $200 whenever she felt like it. She said, there's a bank here, I'll take 2. So I said, Kendra, you're banished. 3 years old, she weighed like 28 pounds, tiny person, horrible temper. She starts walking and say, you're bankrupt, you're bankrupt, you're bankrupt. And I'm very impressed, 3-year-old using the word bankrupt. And I said, Kendra, what does the word bankrupt mean? Expecting an answer like the value of your assets is less than the value of your outstanding liabilities. She said, bankrupt means you don't get to play the game anymore. I thought about it, said, that's a very good definition of bankruptcy. This company is bankrupt. But what's keeping the value of equity afloat? You get to play the game for another 10 years. As long as the game doesn't end, you're not technically done. You heard of vulture investing? You know what vulture investors do? It's a very perverse way of investing. You will pick the most distressed, troubled companies you can find. You buy equity in these companies. You're not buying them for dividends. You're not buying them for cash flows. You're buying them for the same reasons you buy deep out of the money options. You buy equity in 50 deeply troubled companies. 10 years later, when I track these 50 investments, what's happened to most of them? They've been wiped out, right? But the 5 that made it make 5,000% returns. That's the way these portfolios pay off. It's the few big winners, just like all deep out of the money options. Continental Airlines, which was bought by United in 93. After 93, in 1993, Continental Airlines traded at $1 per share. Because like every airline was going through a period of, could it maybe either go bankrupt, Chapter 11, $1 per share. 1 year later, it was trading at $53 per share. Why? Because airlines recover out of the blue. Can you imagine making a 5,200% return? That's never going to happen as a nice, healthy company. That's what you get with distressed equities. You're buying deep out of the money options. So let me ask you a question. If you decide to become a vulture investor, do you want to buy deeply troubled, stable companies or deeply troubled, risky companies? Who wants a deeply troubled, stable company? I don't even know what that means. I lost 200 million last year. I guarantee you I can lose 200 million every year forever. Great, amazing, right? You want deeply troubled, do you want deeply troubled companies with long-term debt or short-term debt? Long-term debt, because you want to think like in terms of optionality, it's going to find you the equities that are most likely to behave like call options. So I'm going to use this example again, and I'm going to revert back to the pre-catastrophe example. Remember the equity was worth 75.94 million? You're now the equity investor, and I'm a project salesman. So I pop into your office, and I'm trying to sell you a project. You're a very canny CFO. So you ask me what the net present value of the project is. And I say minus 2 million. You remember your corporate finance, you get ready to kick me out. They said, no, wait. This is not only a negative net present value project, it's a very risky negative net present value project. This is going from bad to worse, right? Because you're not supposed to take negative net present. You're definitely not supposed to take negative net present value. No, risky negative net present value project. But there's a magic that's going to happen. You're the company, you take this project with a net present value of minus 2 million standard, you're going to actually be able to come out of this process as a winner. Let's see how this magic happens. I took my option pricing model. Remember, when you take a negative net present value project, it knocks down your value as a firm. It used to be 100 million. You've taken a project with a minus $2 million NPV. The value of the firm has gone to 98 million. You see there, I told you not to do this. But remember, I took this project, it was riskier than my business. I pushed up the variance in firm value from, so two things happened. The value of the business has gone down, the variance has gone up. You're still the equity investor. You still owe 80 million on that zero coupon. Remember, your equity is worth 75.94 million before? After I take this bad, risky project, your equity is actually worth 77. It actually went up. File this away. Now, when you get to the other side of the interview table and you get this really cocky person on the other side, ask them, do you think it's a good idea to take negative net present value projects? Of course you should. What about a risky negative? No, never. Then hit them with the example of how equity investors might do that. But you think, where is their value coming from? Why are equity investors better off here? Who's paying? The lenders are paying. This is why you should never lend money on an LBO and leave the equity investors run the company. Banks did this. I mean, and they always wonder, what happened? You let the equity investors, they did the rational thing, which is take care of their interests. And guess how they did it? They transferred value from you as the lenders to them. And the value of the firm might have decreased, but they walk away as winners. This is what we know. If you think about agency costs, it's a big word that we use. This is the agency cost. What's good for lenders and what's good for equity investors can diverge. So it's we're breaking all the rules in corporate finance. Let's keep breaking one more rule. You know, the old saying in an acquisition is you pay fair value. Nobody gets hurt. It's not great. You'd rather pay less than fair value. But let's say you pay exactly fair value, then nobody's hurt, right? It's a zero net present value project. Let's say if that's true. Let's assume you are back to the company, used to be $100 million value, 80 million. You go out and you buy a second firm with a value of 150 million. You're paying exactly 150 million. But that company comes with its own debt, 50 million in debt, 10 years to expiration, and comes in with a standard deviation of 50%. And it's in a different business than your business. You're a steel company, you're buying a technology company. So what's that got to do with anything? When you're in a different business, the correlation between the two companies tends to be lower. If you bought a company in the same business, you tend to move together in a different business. You've now created a combined steel-technology company, right? You know, the variance in that combined company is going to be, it's like magic. You remember the two asset portfolio that you start every finance class with? You have two assets and ask you, what's the variance of the portfolio? Your weight of the first asset squared times the variance of the first asset, plus weight of the second asset times the variance of the second asset. And then there's a final term, right? What does that term capture? The covariance between the two assets. If I use that same formula, it turns out that the variance of the combined firm is 0.154. Here's the magic. You have two companies with variances which are higher. You combine them, you actually created a company that was safer than either company. You see, so what? If I value the equity in this combined company with the lower variance, those are the equity values before I came in. The combined equity value is 210.41. I paid fair value on this acquisition, but my equity has actually dropped 3 million in value. Again, where did the 3 million go? Who's gaining in this deal? Remember those lenders who lend to the individual companies based on their risk? They're waking up much happier today because they've now lent to a much safer company at the same interest rates that they lend to a risky company. There's a transfer of wealth from equity investors to lenders when you create conglomerates. Is there a way I can claw that back though? There are two things I can do that'll allow me as an equity investor to get back this 3 million. The first is I can approach my lenders and ask them to lower interest rates. Say, look, it's not fair. You lend money to riskier companies. We're now a safer company. Restructure the financing. What if they refuse? What can I do? Anybody want to try? I can go out and borrow more money on top of what I already have. By doing that, I essentially make my company riskier again. And I say, you know what? You lent to a riskier company. I'll make my company riskier. Conglomerates that refuse to borrow as they grow will transfer wealth from equity investors. It's not good for stockholders, even if you're paying fair value. So you can see how this abstract example plays out. But if you have, and some of you have equities that I would think of as distressed, they have lots of debt, they're losing money. So can I use this in my company? The example that I gave was very simplistic, right? There were only two claim holders, debt and equity. There was only one bond, a nice zero coupon bond with a maturity. And I gave you the value of the firm and the variance. But in the real world, you'd have to come up with every one of these numbers. So let me lay the guidelines for how you might be able to do that. First, if I ask you for a value of the firm, luckily we're in a class where this is what you've been doing all semester, right? You valued a company, that can become the S in your model, the value of the operating assets. If you hadn't valued your company, you could have used a pricing, 6 times EBITDA, 2 times revenues, but you can start by estimating value. Some people even take the market cap of equity and debt. It's a little bit of cheating. I wouldn't do that, but that's your starting point, value of the firm. That's the easy part. Then ask you, can you give me a variance in that value? Now, this is going to be tough, right? You got one number from your DCF model. But is there a way you could give me a variance in that value? With ExxonMobil, remember what, or Royal Dutch, remember what we did? We let the oil price vary. We did a simulation. If you're willing to do a simulation, you can do that variance, but that's going to be a lot of work. So I'm going to give you a shortcut that's going to take you far less time. Let's say you're valuing a troubled steel company. It doesn't have bonds outstanding, so you can look at the stock price and bond price and get a variance directly. If you go to my website, you remember how I had betas by sector that some of you might have used? I also have standard deviations by sector. So you have a steel company, you can go look up the standard deviation of a typical steel company and use that as your standard deviation, the option pricing model. So I've got the sigma. Now, one of the problems you're going to have with any regular company, which is in trouble, is you're not going to find one nice zero coupon bond. You're going to get dozens and dozens of debt, some short-term, some long-term. Here's what I would suggest. Take all your debt, gather it together, come up with the total value of your debt, including the interest expenses if need be. And then take the weighted average of the maturities of your debt. And if you want to be sophisticated, you can even use durations. What you're trying to do is take all your debt and replace it with what looks like one nice zero coupon bond. You can do that. You can value the equity in a troubled company. So I'm going to close today's class by trying that on Eurotunnel. You guys familiar with Eurotunnel? It's this hole in the ground where cash goes in but never comes out. Because when it was first built, it's of course a tunnel connecting the UK to Europe. It was built because the UK and the French government thought they could make money off it. It's never worked out. It's been a disaster from a financial perspective. In fact, this was a valuation I did of Eurotunnel in 1998. By then, the company was clearly in trouble. Let me back that up. In the most recent year, 97, it had lost 56 million in operating income terms and 685 million pounds in net income. So it's losing money. Its book value of equity had turned negative. What does that tell you? It's been losing money a long time. It's wiped out, whatever. So this is a money-losing company that's been losing money for a long time. Half of the distressed equity argument has been established. And it's a company with a huge amount of debt, 8.9 billion pounds in debt. Much of it very long-term. So you've got the ingredients, right? You've got a money-losing company. It's been losing money a long time. It's got lots of debt. Clearly, you're not buying equity in this company for dividends. You're not going to get those. You don't like, unless you like negative cash flows, you're not buying it for the cash flows. You're buying it for the same reasons you buy an option. So first, I did a discounted cash flow valuation of Eurotunnel. What does that involve? Fixing all the problems, improve margins over time, make them a nice, healthy tunnel. So margins improved over time and I lowered the debt ratio. And what I got as my discounted cash flow value for this tunnel was 2.3 billion pounds. And that's assuming they come back to health. You see what our problem is? Even assuming health, the value that I get for the tunnel is 2.3 billion. They owe almost 9 billion pounds. If this were a DCF, you know what this would look like, right? Value the operating assets 2.3 billion. I subtract out 9 billion in debt. You're going to tell me the equity is worth nothing. Company. And on a DCF basis, be absolutely right. But remember, there's a lot of the debt is long-term and things can happen to that $2.3 billion value. To capture how much that value could change, I try to compute the standard deviation. I tried the trick first of going and looking up the sector standard deviation, but I ran into a bit of a problem. In 1998, there were almost no publicly traded companies in the transportation infrastructure domain. Today, I have a shot. There are toll road companies, then there were none. But Eurotunnel happened to have traded shares and traded bonds. So on the London Stock Exchange, the stocks were traded, the standard deviation was 41%. And on the bond market, their bonds were traded with a standard deviation of 17%. The company was mostly debt, 85% debt, 15% equity. So let's suppose I create a portfolio of Eurotunnel stocks and bonds because I want a variance in the firm value. The variance that I get, allowing for the fact that the two are highly correlated, is 0.0335. What does that mean? My value that I got of 2.3 billion from my DCF could change. It could change a lot over time. I have everything I need to value this option. The S becomes the value of the firm with my discounted cash flow model. The K becomes the $8.9 billion in debt outstanding. The T becomes the weighted average duration or maturity of this debt when this is debt come through. The sigma becomes the 0.0335 that I calculated by looking at traded stocks and bonds. And this is almost miraculous. This is a basket. This is about as bad a company as I ever valued in terms of value versus the debt. But here's the magic. Even with those terrible inputs, the value that I got for the call, which is the value of equity, is 122 million pounds. Talk about being stubborn. Equity is hanging in there. Now, but I'm being realistic. If you look at ND2, what does it tell you? There's a 7.5% chance that this company will make it. So I'm being real and saying, look, 92.5% of the time, the company will not make it. But in spite of that, I will pay 122 million for the equity because there's time on my side. So I will send you an email about those of you who might be able to use this to value equity. Luckily for you, most of you, it's not going to work because you need two things for this to work. One is you need a money-losing company, but you also need the company to have a lot of debt. Many of you have money-losing companies, but you pick young money-losing companies. That's not going to. So luckily for you, that this doesn't apply. But if you have a money-losing company and a lot of debt, you have an option. So here's my bottom line on option. There are lots of options out there. Everybody talks about options. Most of them have no economic value. You can ignore them. And if they do have economic value, be careful before you use an option pricing model because it comes with this replication arbitrage assumption that might or might not. So next session, we're going to talk about acquisition. So I would send you kind of a pre-class test that I want you to run through. It's a very simple test that will set up for the class. I will see you on Monday.
Go ahead, manager rotation.